for the majority of companies in the S&P 500, yesterday was not a great day, nearly red right across the board, and today our focus is on Amazon that reported after the market close. Now we can see investors did not like that at all. The company is down nearly 10% in the pre-market, and this is not a regular occurrence for a big company like Amazon, and we will understand why is it crashing and does this give us a golden opportunity. Now the headline of the report does read that Amazon shares slide on a revenue miss as well as disappointing guidance for the next quarter. Now, in terms of looking at exactly how they performed, on the top line, what we can see here is that they had an EPS of 126. That is a massive beat against what the analysts were targeting of $1.03. And we also note, while they did miss the revenue, it was a very marginal miss, 147.98 versus the 148.56 that we can see analysts wanted to see in the numbers. Now, a few other numbers that they do like to look at, it is Amazon Web Services, which actually was a nice beat, 26.3 billion versus the 26 that we can see here. And the advertising did unfortunately come under, but again, we are talking about a very marginal miss of $200 million, 12.8 versus the 13 billion expected. In terms of the guidance, what we can see here is that Amazon are targeting around 154 to 158.5 billion. Now this will represent 8 to 11% growth on a year-on-year basis. However, what we note when you look at the midpoint of that of 156.25, it does come under the average analyst target of 158.24 billion. So two catalysts for the share price drop that we've seen, not just the miss to the revenue, but we can also note for the full year, they are anticipating it to be marginally lower, around 2 billion than what the analysts were hoping to see. And the final thing to note is that sales in the online segment store grew around 5% year on year. So not a bad earnings report overall. They did do a massive beat on the EPS, as we can clearly see here, and it was a very marginal miss to the revenue. So let's find out, are we seeing an overreaction by the market, and is this an excellent opportunity to add into our portfolios? Now we will take a look at the investor presentation, a few things that we want to point out in terms of massive growth that we are seeing on a quarter-on-quarter basis. But the first thing to understand is the underlying metrics. Is this a high quality company? First thing to note, free cash flow per share, as always, consistent increases over the longer term is what we want to see, and that is pretty much what we get. 21 cents in 2014, 3.13 in 2023, and over the next 12 months it is anticipated to increase at a very rapid rate. So this is a great sign that even though they had 2 years of negative free cash flow, not only has it bounced back in 2023, but over the next 12 months we are expecting massive growth to this metric. Then we look at the sales growth, where we get very nice double-digit increases on a year-on-year basis, and that is what we want to see for a company with the caliber of Amazon. 12% in 2023, and as we read in 2024, they're anticipating around 8 to 11%. So whether or not you believe that there is a massive slowdown in the sales growth number, they are still putting up some very strong numbers overall, and we can see numerically over the last 10 years some massive growth going from 89 billion to 575. Now, in terms of shares outstanding, with the majority of companies, we always love to see them return excess cash back to shareholder pockets. With Amazon, what we have noted over the last 10 years, they have been steadily diluting your position as a shareholder. Now, maybe you don't care given the share price return during the period, but just something to bear in mind, as it is a trend that we have seen continue over the shorter term. In terms of ROIC, as always, 10% or more, just to give us faith management are able to effectively allocate their capital. And what we're seeing, very inconsistent numbers, but from the lows of 4% in 2022, it's rebounded nicely in 23 to 10%, and on a trailing 12-month basis, 15% does look very strong. So hopefully we can see some consistency moving forwards with these numbers. Now, margins also, we want to see a minimum of 16% on a year-on-year basis. Not that great at 6% in 2023. However, what we do notice, it has been increasing, so we are seeing operational efficiency over the longer term. And with 9% on a trailing 12-month basis, the hope here is that we can start to see this number move towards the minimums we want over the longer term. Free cash flow margin as well, minimum 5%. A lot of inconsistency on a year-on-year basis. Nice to note though, from the negative of 2022, rebounding to 6% and expected to increase with the 8% on the trailing 12-month basis. Noted. We then move on to our final metric, which is the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. This correlates to the balance sheet strength. Remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.61 in 2023, expected to go even lower over the next 12 months at 0.27, so they do have a phenomenal balance sheet, and that is something that we will take a look at shortly as well. So now let's take a look at their investors presentation slide deck and see what the numbers tell us. First thing to note then, their net sales on a quarter-on-quarter basis. So Q2 is an increase from the previous quarter, and when we look at it on a year-on-year basis from the same quarter in 2023, we note it is up double digits, 10% on a year-on-year basis. That is nice to note, and when we look at it on a trailing 12-month basis, what we can see quarter-on-quarter, the numbers continue to chug along even higher, and we note 12% growth on a year-on-year perspective. Now that is very strong when we're looking at companies like Amazon that have been typically growing at the 20-30% rate. It is nice to note even at this point they are still growing at a very strong rate of 12%, and that is expected to continue, as we just heard, around 8 to 11% for the full year of 2024. And then we take a look at their operating income. Again, on a year-on-year perspective, it is up 207%, and we can clearly see that on a quarter-on-quarter basis as well, this is a company that continues to increase, not just on the sales, not just on the operating income, but also on the bottom line net income, which is also very important for shareholders. And in fact, the 44 billion that we are seeing here is up 240% on a year-on-year basis. So again, very nice to note, and this is a strong company that even though the share price is down around 10% in the pre-market, this doesn't mean there are some massive issues with the company, just some overreaction in our opinion. But again, do let us know your thoughts as we go along today. Now, one of the areas, or in fact one of the key areas that the market does look at is the results of the AWS, the Amazon Web Services, and what we note on a year-on-year basis, up 19%, and again we can see on a quarter-by-quarter basis this number continues to go higher, and the same can be said for the operating income. What we can see here, it is up around 74% on a year-on-year perspective, so very strong numbers overall. Net sales 98.6 billion, operating income 32.9. Finally, what we want to leave with in terms of the investor presentation is one of the things that we actually want to draw your attention to. It is the free cash flow, and why this is incredibly important, because this is one of the metrics that we love to see over the longer term, consistent increases year on year, and it is up 572%, and it is expected based on management to continue to increase at a very rapid rate. So lots of strength with this company in the numbers. So let's take a look at some other parts of this company. Now, before we do, just to let you know, we have released our latest weekly article. If you want access to this or any others, do click on the pinned comment below and you can start reading straight away for that instant access. Next thing we want to look at is insider ownership, now just below 11%, and we do notice quite a massive amount of sales, 6.8 billion just over the last 12 months, with a massive part coming in quarter 3 of 1.21 billion, but we also see sales in quarter 2 and a very large chunk in quarter 1 of 5.51. Now, in terms of who these insiders are, what we can in fact see, the majority is Bezos. He has been selling a significant amount. And one thing that we have noticed, he is selling all of these when it does hit around the $200 mark. His latest sale did net him around 53 million. Now, this isn't something that we typically tend to use as part of our analysis. Insiders sell for many reasons, whether it's personal or financial, but we do like to highlight it for transparency across all of our in-depth analysis. Next thing we want to draw your attention to is institutional ownership, around 72%, 23 billion worth of sales over the last year, and in the same time period we see a lot more buying, in fact more than triple the amount of buys, and we note in the more recent quarter as well, nearly double the amount of buys, and that is pretty much the trend throughout the quarters, and you'd have to go back as far as quarter 4 of 2022 to see the opposite take place. Now, regardless of insiders or institutions, if they're buying or selling, always do your own due diligence, but you can incorporate this as part of your wider investment thesis. Next thing we want to draw your attention to is not just looking at the top line revenue, but also the story behind the bottom line net income. As we mentioned, over the longer term, this is a company that is still growing, increasing its top line at a double-digit rate. which is always great to see. And when we look at the bottom line net income, we note that there is a bit of inconsistency on a year-on-year basis. In fact, a net loss in 2022. 2023, nice net profit of around 30.4 billion, but we note that is lower than the amount in December of 33.4. So something just to bear in mind, top line revenue increasing at a very strong rate, but the bottom line does look to be a little bit more inconsistent on a year-on-year basis. We then want to take a look at the health of the company, the total cash versus their total debt, and what we see, it sits around 17.4 billion in 2014. Now it has grown very largely to around 89 billion. So similar to their top line revenue, their cash has also increased at a fairly rapid rate over the last 10 years. Now remember, this number in isolation doesn't tell us anything, which is why we always compare it to the total debt numerically and directionally, and that has also increased rapidly, around 14 billion in 2014 to around 133 billion, although we do note that it has come down drastically from December 2023, where it did sit around 30 billion higher. So overall, yes, cash is increasing at a rapid rate, but so is their total debt, which is actually higher than their total cash. But we did see the net debt to EBITDA does look decent, so the balance sheet does look fairly strong for now based on this information. We then want to look at their earnings report, how it's performed historically and moving forwards. And as we mentioned, very large beat just this quarter, and they have a 100% track record when looking at the EPS. Over the next 3 quarters, they're anticipating double-digit increases year on year. Quarter 2 of 2025, around -2%. And if they are able to hit this for December 2025, we will note the forward P will come down to around 31.8. Now, just bear in mind, for those that want to know, the S&P right now is trading at around a 23 forward P basis. We then want to move on to some gradings. Now, the first one is the valuation, where they get a D-. Now, no surprises here, because when you do look at the P moving forwards, it does trade at around 40.21. Now, that is before the drop, so it will come slightly lower. But regardless, we note the sector median around 16, and therefore right now, if you are acquiring this company, you are paying a 158% premium. Now, that is definitely going to be justified. It is a very high quality company, but when we come to the valuation piece, that is when we need to understand, is the price right now worth paying? And what this shows us, pretty much across the board, any valuation method you use, Amazon is trading at a premium. Next thing we look at is the growth A-, so we can start to understand why it does have that premium next to the name. And what we see year on year, around 12.5%, sector median, low single digit. Moving forwards, as we just saw, around 8 to 11%. Again, a lot better than the sector median at that low single digit. And one thing we always want to draw your attention to, earnings per share over the next 3 to 5 years is anticipated to grow around 23%, when the sector as a whole on a median basis a lot lower at 10.98. We then move on to the final grading, which is the profitability, A+, so looking very healthy here. We get the gross profit margin at just under 48%, better than the sector of 36.5%. Bottom line, marginally better at 6.4 versus 4.77, but no surprises here. Something that it blows everyone out of the water. Cash from operations at 99 billion versus the 264 million from the sector median. Now, as a quick wrap up for this part, we get 1 buy rating from Seeking Alpha, a strong buy from Wall Street, and a hold from Quant. We also note D- on valuation, A- on growth, and an A+ on profitability. Final thing before we get to the valuation, how well do they compare against others in the broadline retail industry? We have Alibaba, PDD Holdings, as well as a few others, Melli as well, which reported some very nice earnings just yesterday. And when we look at it over the last 12 months, we know Amazon is up around 40%. Bear in mind, with the pre-market drop of 10%, it will come down. And we can see they are still one of the best performing up there. And when we look over the last 5 years, we still note they are one of the best performing up there. And when we expand it over the last 10 years, again, one of the top performing, up over 1000%. As always, if you enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And in today's episode, our intrinsic value sits at $226. This isn't too dissimilar from Wall Street, who have it at 225 with 36% upside. Now, how we got to 226, we ran it through the DCF model, where we have the free cash flow year on year. Now, the average growth rate, it is skewed due to the larger negative number, but we can see incredible growth in 2023, and that is expected to continue moving forwards, as we saw. Now we have three growth rates, a low, medium and high. We've gone for the medium one of 20%, and we can in fact see, based on the discount rate where we get the present value of future free cash flows and terminal value, we add this number with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we have that massive undervaluation signal, which isn't too far off Wall Street and their price targets. Now, a lot of people will say that is way too high, where therefore we have gone for a conservative estimate of 15%, and just for transparency, you can see that would bring the share price down to around $159. Now, for those that also believe, you know what, that is way too conservative, well, we also have a 25% rate, and that ultimately means an intrinsic value of $319, giving upside of 92%, nearly double the current trading price. As always, you can grab a copy of this model by clicking on the pinned comment below, whether you run through your own numbers for Amazon or for any other company in your portfolio or on your watch list. So we take the 20% through to the next stage, and therefore that does give us that intrinsic value, as we said, not too dissimilar from Wall Street's target. Then we like to use a margin of safety, and as always, we start off with 10% and we use that and execute if it meets our three golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So if you believe that, and you can argue that for Amazon, well, it could be a buy up to $204. And as we can see, the all-time high does sit around that $201 mark that we saw not too long ago. So that would be around a 10% MOS. And then we keep going to see what kind of margin of safety we have in today's episode based on the estimates and judgments. And right now, up to around $170, we believe that Amazon has a 25% MOS. And as we saw, not only do Wall Street believe it has 36% upside, but they also gave it a strong buy rating. Now, this is a company that continues to grow quarter on quarter, and they did have a marginal revenue miss. And as we saw, the market also reacted negatively when we looked at their guidance, which was marginally off what Wall Street wanted to see. As always though, do let us know your thoughts in the comments below. This definitely looks like one that we are considering in our own portfolio. But if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click on the pinned comment below so you can sign up to the weekly newsletter, and also join us in the Patreon if you want to be discussing our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.